Good day. My name is Ian Scott. I'm the head of fixed income and momentum investments, and today we are going to talk about the fixed income markets and particularly the South African fixed income markets. Sure, 2020 has been an interesting year so far, and yes, March was not pretty for most asset classes, and we've seen most asset prices come under a severe amount of strain, and we've also seen that with South African bonds as well. But the good news is we think there are good opportunities in times of crisis. It's the first time that in my career history we've seen this double whammy of firstly we've had the market sell-off, and yes, now this virus that's all new to us and a new way of doing things. But given what has been said and done, I think there's good opportunity in the South African fixed income markets because the news is so negative and there's a lot of negative factors already reflected in the price of South African fixed income. But let's start with the world. We don't live in isolation. We live in a bigger world. What's happening in the world? Well, the world is in recession, and it's probably going to be in recession for a while. Inflation is falling. We've seen what's happened to the oil price. That means inflation in the world is going to be a lot lower. Think about it. The oil price and the petrol price is falling. Petrol is cheaper than it's been in a long time in South Africa and in the world. We've seen central banks cut rates significantly. If we think about our own SARB that have cut rates so far, there's 225 basis points and there's more cuts to come. So putting it all into perspective, this is an environment that's very good for bonds, believe it or not. Think about it. The world is in recession and low growth. In South Africa, we think that growth will be minus 5% this year. Inflation is forecasted to be between 2.5% and 3%. And the SARB is cutting rates. These are a massive tailwind for South African fixed income. It's good times for bonds, but it doesn't feel so. But remember, it's in times when it doesn't feel naturally like it's good for markets. It really is a good time for markets, especially fixed income. So to think about it, that we think cash in South Africa is very attractive, that if inflation is going to be between 2.5% and 3%, you can earn 6 or 7% in a money market fund. Now that's inflation plus 3 or 4 depending on where you are on the curve. That's very attractive. If we start looking at South African bonds, now I said to you, inflation is 2 or 3%. The 10-year bond is sitting at 11%. That means inflation plus 8 or 8.5 that you'll get from bonds. We haven't seen real returns like this in 22 years. The last time that we've seen real rates as high was in 1998 when Chris Stolz took the prime rate to 25% and government bond yields peaked at 21.5%. So I made the prediction that South African bonds are very attractive at this point in time because why? Because of what we call fixed income, the income part of it. Because what is happening in other asset classes, if you think about equities, what are most companies doing at the moment? They're not declaring and distributing dividends, so you're not getting any income from equities. Property companies, they're earning rentals, but they're not declaring rental distributions. You're earning no income from property. Yet fixed income, we earn a coupon. They have to pay us. We are lenders. If they don't pay us our coupon on time, we will declare default on them. So I've made a prediction that South Africa's fixed income will be one of the best income producing asset classes over the next 2 years. If the bond market goes nowhere for the next year or two, you will make an 8% coupon return. Now that's inflation plus 5.5 without doing anything. And the second point is it's at low risk. Why is it at low risk? Because there's so much bad news in South African bond prices at the moment. What do I mean? Well, firstly, Eskom is already reflected in the South African bond price. Bad government finances. We know the government finances are poor. It's reflected in prices. Markets don't live in absolution. They price these things. Third thing, everybody was very concerned around the sovereign downgrade this year. Well, that's not past us. Yes, we're going through the last bits of after effect of the reweighting of the global bond index and all sorts of technical stuff. But that's not past us. We are high yield or junk, if you want to call us. So we think a lot of the bad news already is reflected in the South African bond market. Now, the best opportunities in the market are found when the news are negative, and there's plenty of negative news out there, but the market has not gotten on that the prices, or the investors, that the prices are reflecting the bad news. That's why we still believe that South African fixed income is one of the best asset classes on a risk-adjusted basis over the next few years. Our third part, credit. There are some great opportunities in credit. For the last few years, we've been shying away from credit because it was very expensive. We've seen a big change in prices. Prices fell in the credit market, and now a lot of credit looks a lot more attractive to us. We think at low risk, you can probably get an 8% type return out of credit without taking a massive amount of duration risk, like our enhanced yield product. We think there's a good opportunity for investors willing to take a little bit more risk than just pure money market. So what we're saying at the moment is that there's good opportunities in the South African fixed income markets because, one, you've got this global tailwind from central banks cutting rates, doing QE. Central banks are throwing fiscal measures towards economies. Two, our own SARB is cutting rates. Inflation is falling. Growth is negative. We've seen a massive stimulus package, the 500 billion from government. These are all good things for South African fixed income markets, supporting markets. We've seen the SARB come out supporting liquidity in the bond market. These are all very important signals and measures for the bond market. But you don't feel it because you feel negative in your stomach. But those are usually the best times for investment. So my appeal to you today is to really look at your portfolio and your investors' portfolio, saying, how much fixed income do I really have in my portfolio? Should I have more? Because I have the ability at a low risk to generate a high level of income for my investors over the next year or two when other asset classes will not be able to do it. And we think this is one of the standout opportunities in South African fixed income when prices are low, a lot of negative news are reflected, and you're willing or able to buy assets at very cheap prices. And we think this will go on for a period of time. If I listen to Herman and Sanisha, we're going through a troubled period for a period of time. It's not going to be a one and done and we're over. So if you can get an 8.5% coupon out of South African fixed income without doing a lot and not taking a lot of risk, we think it's a good opportunity for investors and pensioners and savers to be in the South African market because inflation will remain low. The South African Reserve Bank, we think, will probably cut rates by another 50 to 100 basis points over the next few months. So yes, there's big tailwinds and big opportunities in the South African bond market to be had. And we will say to investors, really look at your portfolio, think about the income needs of your investors, of your portfolio over the next 2 years. And use this opportunity in the fixed income markets to allocate and not just sit in cash and earn a 3 or a 4% in your banking deposit. You're really incentivized to what we call go up the curve, put a little bit more duration on your portfolio and really earn a high yield without taking equity risk. This is one of the few opportunities where you're getting equity like real performance for taking bond risk, and that's why we believe this is a good opportunity for investors in South Africa.